Drenard Trust here. In this video, I'm going to break down Trump's August 2025 tariffs, how it can negatively impact the market, right? Meaning it's a trap, and also how you can protect yourself and maximize the opportunities if there are any, right? So let's get into it. So Trump's August 2025 tariffs introduced sweeping new duties on nearly 70 countries, raising the average U.S. effective tariff rate to 18.3%, the highest since 1934. So these tariffs have produced both direct revenue for the U.S. government and significant costs for households and businesses. So please take a moment to hit the subscribe button and the like button. Please take a moment to hit the subscribe button and the like button. Let's talk about the government revenue, right? By July 2025, the U.S. Treasury collected $124 billion from tariffs, more than doubling the prior year's revenue. Treasury officials project total collections could approach $300 billion by year end as new tariffs are implemented, right? So Canada, the tariffs were raised from 25 to 35%. Brazil, it jumped from 10% to 50% on a range of imports. The European Union set at 15% under a recent deal. South Korea, 15% on imports following a trade agreement. Nearly all major U.S. trading partners now face a minimum of 10%, with some rates, particularly on metals and select manufactured goods, spiking well above 40%. Now, U.S. households are projected to bear an average additional cost of $2,400 in 2025 due to these tariffs, with clothing and consumer goods disproportionately affected. U.S. companies, especially in consumer products, experienced revenue declines. Like Berkshire Hathaway reported a 5.1% drop in its consumer goods division, directly attributed to tariffs, right? There was the elimination of the de minimis exemption, right? As of August 29, shipments in regards to the tariffs under 800 now face more tariffs, right? Closing a previous tax loophole on low value imports. There's a macroeconomic effect. So stock markets, it's basically dropped, markedly as tariffs took effect, with major indices falling after the announcement. So experts are warning of stagflation, which is a slowdown in growth combined with higher prices. So inflation is at 2.7%, with forecasts of at least 1 point increase over the coming year due to the tariffs. There is a job market strain aspect as well, right? Hiring, slowed significantly, and business investment is expected to remain weak as companies face ongoing tariff uncertainty. Now, again, Donald Trump's August 2025 tariffs basically involve a sweeping country-specific reciprocal, whether it's 10% and upwards to 41% for certain countries, right? And basically all virtually imported goods entering the U.S. However, this extensive tariff, again, it has negative impacts, because of the costs, the margins, and the corporate earnings, right? Tariffs act as an immediate tax on imported goods. U.S. companies reliant on foreign inputs or finished products such as retail, automotive, manufacturing, and technology face higher costs, right? So with that being said, they got higher costs, they got to do some, stocks go down, you know what I mean? So the empirical data from Goldman Sachs in July 2025 suggests roughly half of these cost increases are passed to U.S. consumers, with 39% borne by domestic businesses, directly cutting into corporate profit margins and eroding earnings. So, you have reduced earnings that lead to negative earning revisions, triggering stock sell-offs and suppressing future stock price growth. Now, in regards to inflation and consumer demand, of how this can negatively impact the stock market, making it a trap, potentially, you have the broad-based tariffs, right, which is basically reaching an average of 18.4% to 27%, okay, July 2025, which drove widespread price inflation for consumers, reducing real disposable income and suppressing consumer demand, the largest driver of U.S. GDP. So as consumer spending slows, firms face reduced revenues, compounding the negative effect on profits and the overall market. Okay, so tariffs disrupt global supply chains, causing delays, shortages, and increased logistics costs. So for many multinational companies, the inability to swiftly adapt production or sourcing erodes operational efficiency and increase earnings uncertainty. So uncertainty about further retaliatory trade actions or changing tariff structures leads to investor caution, higher risk premiums, and stock price volatility. So US trading partners, whether it's Canada, China, Mexico, have retaliated with their own tariffs, in some cases as high as 125% on US goods. So US exporters, particularly in agriculture, manufacturing, and tech, face lost market access and falling revenues as foreign buyers turn to alternative suppliers. So, April 2025 saw simultaneous sell-offs in US stocks, bonds, and the dollar, which is rare in modern history, which is triggered by the Liberation Day tariff announcements. So initially, capital flight to bonds pushed down yields, but as confidence in US fiscal management waned, yields reversed and spiked, raising borrowing costs for corporations and households. So there was elevated yields, inflation worries, and policy unpredictability that created a hostile environment for risky assets, whether it's stocks, prompting further declines. So, rapid declines in equity indexes like the Dow falling 530 points or 1.2% upon tariff news erode investor confidence, drive margin calls, and may spill over into consumer real-world behavior, which is the wealth effect. So as portfolios shrink and 401k values decline, both institutional and retail investors may shift to safer assets or reduce spending, compounding macroeconomic pressure and prolonging market weakness. Now, there's the cost shock, right? If you forget everything, keep this in mind. There's the cost shock. So higher input costs squeeze profits. There's the earnings risk. So downward revisions to growth expectations depress valuations. There's the inflation aspect, which is pass-through effects weaken demand. There's the supply chain disruption, heightened operational risks, raise equity, risk premiums. The retaliation, right? So we give them a tariff, they give us one back, right? The U.S. exporter sales fall, especially in tariffed sectors. There's uncertainty in regards to premiums, so the volatility rises, bid-ask spreads widen, and risk appetite drops. Okay, so if you're looking for real-world evidence, right, we have in April 2nd, 2025, tariff announcements triggered a global stock market crash with broad panic selling across equities, bonds, and currencies. The S&P 500 and major indexes suffered large, rapid drops upon fresh tariff headlines. Market rallies following tariff delays highlight volatility and the market sensitivity to this policy uncertainty. So some market reactions are muted or partially offset by expectations of future policy reversal or Federal Reserve intervention. So the magnitude of impact varies by sector. Export, heavy, or import dependent industries are most affected. Domestically focused on, protected firms may benefit from reduced foreign competition. You can prepare for this, right? And take advantage of the declining stock market, right? As of these August 2025, tariffs. Now, what you're gonna have to do, you have to be practical. You have to reduce your exposure to the most vulnerable sectors. Large parts of the market reliant on global manufacturing, such as consumer discretionary, whether it's retail, apparel, technology, and automakers, are at high risks of, from tariffs. Scaling back investments in big, tech stocks with a considerable China exposure, whether it's Apple, Nvidia, Qualcomm, mass retailers like Nike, and automakers, whether it's GM, Tesla, is recommended by multiple analysts. There is going to be increased exposure to domestic beneficiaries. So tariffs are generally designed to favor US-based manufacturers. So some domestic producers, particularly in sectors like copper mining, whether it's Freeport, McMoran, Southern Cooper Corporation, may benefit from reduced foreign competition. You want to build cash reserves. So as uncertainty rises and market momentum turns negative, many investors prepare by holding more cash rather than investing aggressively. This allows flexibility to buy low when prices bottom out, taking advantage of the panic selling environment. Now, you're going to want to consider defensive stocks and safe havens. So sector less exposed to global supply chains such as utilities, healthcare, and consumer staples typically weather tariff-induced declines better and may help stabilize your portfolio. You want to use, market indicators to time entry. So tools like the Fear and Greed Index, which aggregates volatility, options, momentum, etc., can indicate when market sentiment is at its lowest, a traditional cue for contrarian long-term investors to start picking up bargains. You want to diversify internationally with caution. So be mindful that tariffs can cause currency volatility and hit foreign markets, so U.S. assets may be relatively more attractive, but maintaining a measured allocation in international assets can still provide broader diversification benefits. You want to adopt a long-term perspective. So while markets may drop significantly in response to shocks like sweeping new tariffs, such declines often present opportunities to invest in quality companies or index funds at a discount. So the S&P 500 and NASDAQ tend to recover from sharp corrections over time. Okay, so in turbulent periods, reassess your risk profile to ensure your asset allocation matches your ability to endure short-term losses, right? This is especially important for Americans close to retirement. So stay informed and avoid panic selling. Markets react strongly to policy surprises and global headlines, but indiscriminate selling often crystallizes losses. So systematically reviewing portfolio exposure and acting according to a plan, not emotions, can set up future gains. So that's what I have for you today. Please take a moment right now to hit that subscribe button and the like button. If you appreciate this video and you want more videos like this, please take a moment right now to hit that subscribe button and the like button. I appreciate your viewership. Stay safe and see you on the next video.